number under the inventory. So when you look at the number, it's so beautiful. However, if you look into the detail, those inventory has become just totally obsolete already. No market value already. You know what? The statement is fraudulent. That kind of statement is totally fraudulent. All right? Like Enron, like a tyco, So when we read the statement, we don't just focus on the number. And eventually, that is CPA firm. They need to do the auditing. When the CPA firm they do the auditing, they need to check the inventory. They need to verify whether or not this value still reflects market value. Otherwise, mean nothing. So very good questions. Okay. We say blur line. Sometimes it's really blurred. Okay. If you report $1 on the assets, we trust you. This is a $1 value. But when I say blur line, mean if the inventories become obsolete already, eventually it's expenses. It is expenses. You know what? If the item move from assets to expenses, there are double effect on the financial report. Number one, it reduce your company's value, right? Because assets reduce your value, right, of the company. In the meantime, reduce your income. For the public company, they're really looking for the income. For each stock, up and down, really follow your income. When your income drop, your stock price drop. So see how crucial it is. So when I say this blurred line, it really is. When you move one item from your assets, from the inventory, not only reduce the value of the company, but also it will directly affect the value on the stock market right away. So for your questions, unless you can prove your inventory become totally obsolete, otherwise still there, still is your assets. Okay, we will not talk about right now, but for our last class, we will talk about financial analysis. There is one very important financial analysis. It's called quick ratio. Quick, Q-U-I-C-K. Quick ratio. Okay, that means you have your current liability versus your current assets. Usually, you better keep 1.5. Better to keep one. Say you have $1 to pay within 30 days. You reserve $1.5. You reserve $1.5. Minimum is 1. That means you have a liability $1 with 30 days. You're better off you have $1 sitting there. $1 not necessarily cash, but you have $1 say account receivable, $1 supplies, and $1 prepaid expenses standing by. If you see this ratio below 1, you know this company got trouble. If this ratio below 1 mean what? Mean likely this company may go default. Default mean overdue. Overdue, alright? So down the road we'll see that, okay? Because for this class, as I say, okay, my basic goal for you is you can prepare your own business financial statement. And secondary is you can read, you understand, and then you know how to do the analysis as an investment. So let's do a few examples here. On your page 54, remember I told you? On the bottom of page 54, there are 5 categories. They are here. Assets, liability, equity, revenue, expenses. So once in a while you got confused. Where should I put this item, to which box, to which category? You got confused. You look page 54. Alright, give you at least basic idea. So no problem for cash, right? for short-term investment, account receivable, notes receivable, anything receivable, inventory, supplies, prepaid item, long-term, equipment, building, land, intangible, no problem. Assets. Liability, anything payable, everything payable. Be careful here, okay? When you see expenses payable, that's liability. Alright? When you see expense, is expense. But when you see expense, everything say payable, that is liability. Be careful, right? Another thing. Unearned revenue is liability. We will talk about this next time. That means somebody is prepared to you. Somebody prepaid to you. You received cash. But this is not earned yet. Say for example, you are the landlord. Your tenant give you the prepayment 6 months and they just move in. You receive 6 months rent. You receive cash. Of course, your cash increase, right? But not necessary revenue. At this moment, you will enter into liability. So that's why I say sometimes it's very difficult. You don't enter here. Do not get entry here. Okay, anything somebody prepaid to you become your one entry go to your assets because your cash increase. However, your liability also increase. Why? Because you are liable to provide your service or to provide the delivery. Alright? So we will talk about this. Keep this in your mind. Because next time when we give you example, if you remember today we talk about this, a lot easy. Otherwise you get confused. Okay, equity should be easier. Okay, there are 2 times equity. Keep this in your mind. Okay, memorize. Okay, 2 types of equity. One is contribute capital, the money or the assets you put into your business. Okay, the assets, the resource you put in, that's called contribute. This first time. The other time we talked about already. You earn it, you return. Okay, the profit generated from your business and you return. So 2 different types capital equity. Okay, one is you contribute, the other one you earn from the business. Easy. Okay, revenue easy. Anything from sales, anything. Okay, so revenue should be easy. Okay, and expenses is not easy. Okay, expenses usually confused with as a liability. So we have cost of goods sold. We'll talk about this. This is a big deal. Cost of goods sold. Okay. Before we sold it, the cost is underneath assets. Only upon the time we sold it and we move from the assets to cost of goods sold, and that's expenses. We will see that probably next time. Okay, with this in your mind, let's go to our example here. Oh, another one before we do that. T account. Throughout this semester, we will use T account format T. Okay. On the left, for each account, we have a T, big letter T. On the left is called debit side. On the right is called credit side. We will see that very soon. Here it is. Very important. Very, very important. I cannot see how more important could be. Okay, this is on your page.
It's also on the whiteboard there.
61. It's also on my right board. Write it down, okay? And the reason why I recommend to write it down because help to memorize it. Right. This is a learning systems, okay? You can just copy, just see this. But when you write it once, you easier to memorize, to keep in your memory. Very, very important, okay? And there's one story, okay? I have my experience. I have 20, 30 students sitting here, just like you before. True story, okay? And after the first class, and 50% disappear, and they drop. And the only reason they drop, because they cannot overcome this diagram. That's the only reason why. They just cannot make sense all of from this diagram. But let me tell you what, no sense to make, just memorize. There's no sense to make, so don't sit in there and try to figure out why. There's no why. This is the rule. There's no reason why. So please don't drop, okay? Let me see you sitting here next time. Don't drop, okay? And the reason why you can sit in here is you just don't figure out the reason why. There's no reason why. Just memorize. This is the rule. We need to base on this rule to do our homework, to do our exercise. So if this is SS, okay, number one, T account, right? This big T there, right? And always the same, debit on the left, credit on the right. And don't figure out why. No reason why. This is a rule. Okay? So debit doesn't mean nothing. Debit on your T account only mean on the left side. This is it. And credit only designate to the right side. That's all. Okay? No any literal meaning there. No, nothing. Okay? Then, remember we have 5 categories, right? If this is assets, if assets increase, you enter into the left side. If this is assets decrease, you enter into the right side. That's simple. And no reason why. Don't ask me reason why. No reason why. If you ask me, I know you gotta disappear. Okay? Don't disappear. Alright? If this is liability or equity, then opposite. Just flip around. And little bit tough is for expenses. Expenses follow up the same size of assets. Right? Because expenses gonna offset owner's interest, right? So so expenses gonna offset each dollar you spend as expenses gonna reduce your equity, right? So expenses is flip around equity. So in other words, if you this item is expenses, if incur expenses on the left side, I certainly see you reduce expenses. So when we incur the expenses, usually is on the left side, unless refund or something wrong. You have a revert. Otherwise, when we do the expenses account, usually enter to the left side, and then the last thing, revenue, is opposite to expenses. This is it. Okay. Only I don't ask you any other thing. Okay. I only ask you to do this, and don't ask me why. This is it. Okay. Okay. Having said this, let's do our example here. Okay, here, all right. Okay, this is our next page. You just start out your new business. And if this is a corporation, okay, and just like Catherine mentioned a while ago, you want to raise the money, okay? You want to raise by little money, say $2,000. Somebody come in and say, okay, I can invest your business by $2,000, but I want to get your stock certificate. You say it's okay. I issue you stock certificate. So right now, your company received $2,000, and in the meantime, you issue the stock certificate. Okay, so the whole thing, we said this is a transaction. Okay, this is one transaction. Your company received $2,000. In the meantime, issue $2,000 value stock certificate. So everybody, let's do this exercise. You want to do the T account entry. You need to pick up 2 accounts. And the balance must be the same and must be on opposite side. So anybody can tell me how will you do it? I'll give it to you later on. Okay. This is in your book, page 58. Yes?
Cash.
Okay. Yes, very good. For every transaction involve cash, we pick up cash first. Remember, this is a rule, okay? This is a hint, okay? Will make your life a lot easier. Alright? Because if you pick up the wrong thing or wrong, sequence, even though we make the right number, we may put on the wrong side. Be careful, okay? Yes, here we receive cash. You'll receive cash. So cash increase. And we all know cash is assets. When cash assets increase, which side you will entry? Left. Left is debit. Okay, as a beginner we say left, but when we get more and more advanced we say debit. Alright? Because as an accounting professional, we don't say left, alright? It's not professional, okay? After we learn this class, when we go out to the real world, we don't say left, we don't say right. Otherwise, don't tell them you learn from Professor Tong. Alright? We say debit later on. But right now, just for practice purposes, we said cash left. Okay? Okay, this is the fun part, okay? Finally, we go to the fun part, okay? So we receive cash, $2,000. So this is a T account, right? T account. And we know when assets increase, we debit it. We say put to the left side. So that, gradually we say we have cash debit by $2,000. But not finished yet, right? It must be duality, must be multiple. So what else account we will pick? Jackson, you want to try? What else account? The other account you want to pick in order to match $2,000 on the right side.
Liability.
No. Slowly. Oh yes. I don't blame on Jackson, okay? Because as a beginner, sometimes we may think this is liability because we are liable to pay it back. But not true, right? Because this person come in, give you $2,000, does not ask you to pay it back. Because in exchange, this person get a stock. Stock means this person is one of the owner. That really means if the business really go wrong, you don't pay back. You don't pay back. So it is not liability, it's another account. Anybody else want to try, or Jackson want to correct yourself? Equity. Remember, I say equity, there are 2 types of equity, right? One is called contribute. This is contribute. This is a type 1 equity. At the beginning of the business, you don't have type 2, right? Eventually for Silicon Valley, there's never type 2. People just go IPO and then close and start out another one, right? So this is type 1. So yes, we pick out stock, common stock. We always say equity, so we say. Everybody, stock is not liability. Okay? Stock is type 1 equity. And equity, remember when equity increase is on the right side. You see the chart there, right? Always keep this in mind. For the whole semester, we need to rely on this. We need to. Then for this transaction, boom, finish. Correct. Any questions so far? It's okay, right? Okay. Next one. Right now, we need more money. We need more money. And well, at this moment, this time, we don't have investor. But very luckily, your uncle would like to lend you $6,000. And you enter into the promissory note. You say, I received 6,000 cash from my uncle. However, I promise that to pay you back in 2 years and bear 5% interest annual rate whatsoever. All right? So anybody want to try this transaction? You need to enter into tier account. Again, cash involved. So we have cash here. Make your life easy. Oh, let me simplify. No interest, okay? Your uncle is so nice to you. As long as you can pay back in 2 years, it will be fine. Okay? Okay? Take it. Okay? Just remember pay me back. That's it. Alright? So 6,000 on the left side, no problem. How about the other account?
Notes payable.
Everybody? Everybody else? It's liability, but what's the name of the account? Very good, you pick out the right category, it's fine. But you need to pick out the name. What's the name of the account?
Note payable.
Yes. Let me give you a hint, okay? Under the liability, 99% is something payable. Easy, right? Unless unearned earning. Unearned earning is a very special one. Unearned earning is somebody prepaid to you. Otherwise, 99% under the liability, there are something payable. So here is called note payable. There is no very rigid regulation to name the account. Okay, just pick out something payable, should be fine. So here is note payable. So note payable, you know. All right, so this transaction done. We have assets increased by 6,000. We have a liability increased by 6,000. So one is on left, one is on right, same amount, balance, finish. By the way, everybody, for each transaction, we must pick out 2 or 3, sometimes even 4 tier account. All right? And the amount on the left must be same on the right. However, those tier accounts sometimes may come from same category. Say 2 tier accounts from assets. Maybe. Alright, I will give you more example. Right? Right now, we just seen one is from assets match equity. We have one assets match liability. But down the road, we'll see more variety. We'll see. Next one. This time, your company go out to purchase equipment or inventory. Okay, so right now, say purchase equipment, say computer. Okay, printer, desk, chairs, whatsoever. You spend $10,000, and you pay $2,000 by cash, and $8,000 payable within 30 days. Cash again, we involve cash, right? So we pay $2,000 cash. Cash right now reduced, right? So this time we will say for this transaction. Oh, everybody, by the way, we use T account to demonstrate the number. In real life, you don't see T account. In real life, you use QuickBook, you use any other software, you just fill in the number there. You don't see this. Right now, only use a T account to demonstrate how the number goes, okay? All right? Eventually, in real life, you have the amount, you have the day, you have the event, okay? All right, you pay 2,000 cash. What else? What else? There are another two accounts we need to match.
Accounts payable.
Yes. Account payable. So anything payable, that's liability. Right? We say account payable because this is paid within 30 days. So account payable. And when liability increase, you want to enter how much? How much? Everybody, how much? I need to be very, very careful because for this kind of process, I know it's very easy for my student to fall asleep. So I want to make sure you are still awake, all right? How much?
2,000.
Oh,
8,000, right?
out loud.
8,000.
Yeah, 8,000. Okay, one last, another account. We go out to buy computer, printer, desk, chairs. What kind of items they are?
Office equipment.
Office.
Supply equipment.
Yeah, I would rather say equipment, but not supplies. Yeah. Even though under the taxation, under the tax code, we may be able to write it off right away, but it's not like paper, right? It's not like a toner, right? You can use it for more than 1 year. You can use this item for more than 1 year. I will trade it as equipment. Equipment is assets, right? In real life, you need to itemize each item. But for here, I just say put everything together. And which side, everybody? Equipment is assets, right? Assets increase, right? So it's a debit side. So I have a debit equipment by $10,000. So we have 10,000 here. So 2,000 on the right, 8,000 on the right. So balance. So here you see for this transaction, we have two items, assets. But one increase, one reduce. We have one item under liability. Right. I just want to show you how much different kind of variety combination could be. So far so good. Another day, your customer, assuming you have ongoing business, come to ask you to lend $3,000 for them to do something related, business related. Assuming everything is legitimate, okay? And you think it's okay. And you say, you agree. So you did lend $3,000 cash to them, and they promise return back, say, in 30 days. So this transaction happened. How will you enter here? Again, cash involved, right? So So you have what?
Cash decrease.
Cash on
Right.
credit side. So
On the right.
gradually we say credit side. Okay, we say credit 3,000 of cash. And what about the other? You can say no to receivable. I don't care. Something receivable, right? Must be something receivable, right? So everything receivable is assets. Everything receivable is assets. No problem, right? So far. You can say no to receivable. And receivable is assets. When assets increase, yes. Okay, everybody agree? Right now? No to receivable, can receivable. I don't care. Something receivable. So you see, for this example, they are all both under the assets. See, could be one asset decrease, the other assets increase, and for this example, it's same amount. So far, okay? We have 2 more to go for today. Next day, your company spent $1,000 cash purchased over the open market, say Apple computer. You just invest $1,000 cash. You say, I don't want to see my cash sitting there to earn nothing. I just want to do a very short term investment. A little bit tough, okay? So you spend $1,000 and you get $1,000 value Apple stock. Again, cash, right? Reduce, easy. How about Apple stock? Anybody else?
Is that true?
Yes, it's also assets. It's also assets. Because this Apple stock is, you can sell it very soon, short-term investment. It's not only the assets, it could be the current assets, right? Very good. So it create another asset account. You can say this short-term investment. For investment, usually, okay. Next one, last one for today. By the end of the year, your company does receive the net income, and then your board of directors declare, will distribute $3,000 earning to shareholder, but just declare, and this dividend will be distributed in 2 months. So by the time your company just announce this news, this one is a little bit difficult, okay? By the time your company just announce this news, say in 2 months, your company will distribute $3,000 dividend. Just by this news, how will you entry P account? Yes, but more specific.
Dividend payable.
Very good. Dividend payable, everything payable is liability, right? Because you have not paid yet, so don't touch cash. There's no cash yet, right? So your company incur certain type of liability is called dividend payable. Dividend payable. Okay. What about the other account? You want to mention it? Oh, by the way, anything payable is liability, right? Right? Am I right so far?
Yeah.
Sometimes you pick out the right account, but you put on the wrong side. You may. And which account you want to pick to match this? A little bit difficult, okay?
Revenue.
Okay, all right. Okay. Okay. All right, very good. Then complete, finish.
Revenue decrease.
Could be. I want everybody just absorb a little bit, right? Because there are only 5 accounts. There are only 5 accounts. Can everybody follow up? Or you have any other input? Yeah. I think this is a very good answer. Revenue here, right? But you see, revenue, we don't know how much total. We don't care because there's not the issue right here. But the dividend generate from the eventually dividend is gonna pay out from return earning, but we don't make that complicated. Eventually, I want to stop for a while, okay, because could be very complicated. But before I say that, I want to hear your idea, because Catherine say we can go ahead distribute this 3,000 from revenue, but I just don't feel 100% comfortable. For small business, maybe you can do that, but for corporation, I'm a little bit hesitant. Anybody know what's my concern here? What is my concern here?
Could it be that it's actually an expense, a dividend expense? Could it be that it's part of retained earnings and it impacts retained earnings and working in the balance sheet?
Yeah. The reason why I don't feel comfortable, because the amount paid, $3,000 amount paid, should be from return earning, not from revenue. Remember this one slide I told you? By the end of the year, when we close out the book, income statement eventually totally disappear. Income statement is not a continual report. Every year, it become disappear. Why? Because the number appear on the revenue will be what? Remember that? I say related to each other. Revenue will go to retained earning. Whatsoever the amount appear on the revenue, or say revenue minus expenses, net profit, the amount on the net profit will go to retained earning. So eventually this $3,000 will be paid out from retained earning. So this $3,000 eventually is not from revenue, it's from return earning. And return earning is on the equity account. Equity account. Even though you have the same size, same number, but I don't want you to pick out the revenue, because revenue is more like a temporary account. So I think much better. Okay. So I appreciate Catherine give us idea, but I think Koreans should be returned. All right, let me give you the homework for the second homework of the day. I will email to you. It is also in your book, okay? So, what is a GAAP? This is your first one. On your page, 88. I will email to you, but if you can write it down. E2-12, recording journal entries, very similar to the exercise we just done. BMW, blah blah blah. Well, if you don't want to use euro, use dollar will be fine. I don't care. Right. Just follow the number. They are A, B, C, D, E, F, G. There are 7 transactions there. Okay, 7 transactions there. You just follow out the exercise we just did that, and you do your T account entry. I want to see if you pick out the right account, if you pick on the right side, and bottom line is the balance. Any questions so far? And please write it down our class schedule. Yes, Catherine.
Stock is belong to which account?
Stock is another equity. Okay, stock is another category. So let me put it this way. For equity, eventually should be very easy, okay? Stock is contribute capital. And say type 1, okay? Say type 1, type 2. Type 1 is whatever you put in, either cash or equipment or whatsoever you put in. So stock is called common stock, okay? It's type 1 equity. And type 2 is return earning. So that is the net profit from each year income statement, and then we close the book, we put that number to the return earning.
Any payable is liability.
So, one more time.
Any payable account payable
Yeah,
is
usually something payable is liability. 99% liability is something payable. Only 1% is called unearned revenue, or say somebody prepared to you. And that's on the slide. Okay, I will send you the email. Any other questions?
So we're only doing E2-12.
Yes, only one questions, and there are 7 transactions. So if you feel the burden is too much, let me know. But I only give you twice homework. So today is the first time, and probably the session number 3, number 4. So any questions so far? I bet you learned something new today, right? So let me see you next time, right? Okay?
Can I use the homework?
Yes. Okay, thank you so much.
Thank you.